Hey everyone, welcome to This Explainer. So, if you're a fitness enthusiast or even an aspiring entrepreneur, you've probably walked into a packed fitness center and thought, wow, this place must be an absolute gold mine. Well, today we're uncovering the real business math behind fitness facilities. Let's dive right in. It really is the million-dollar question, right? And honestly, sometimes literally $1 million. In this explainer, we're going to look way past the sweaty, energetic vibe, the blaring music, and those shiny free weights. We want to see the cold, hard financial reality of running a fitness business. Because right beneath the surface of every single successful gym is a highly complex machine of cash flow, churn, and some seriously high-stakes investments.
Okay, here's our roadmap for today. We'll be tracking the money from opening day all the way to ultimate profitability. We'll hit the initial investment, the monthly burn rate, building that revenue engine, mapping the path to profitability, and finally weighing the risks against the final ROI.
Let's kick things off with Section 1, the initial investment, or as it's pretty much known in the industry, the massive capital drain of opening your doors. You know, it's so easy to just picture a gym as a giant room full of heavy stuff. But before a single treadmill is even plugged in, that empty square footage needs major infrastructure investments. You're looking at massive lease deposits and intense structural renovations. I mean, you need specialized, heavy-duty flooring that won't crack in half when someone drops a barbell. You need wall-to-wall mirrors, high-energy lighting, and perhaps most crucially and expensively, industrial-grade HVAC systems. Keeping a packed room full of sweating, heavily breathing people cool and preventing all that humidity from literally rusting your equipment, that is a massive engineering feat. So all of that preparation really adds up. The dollar figures required just to secure the location and prep the physical space? Prepare for some serious sticker shock here. We are talking hundreds of thousands of dollars, and honestly, sometimes crossing well into the seven-figure mark before you even open for business on day one. It is an incredibly steep mountain to climb. And here is a super common misconception. People always think the physical gym equipment is the biggest expense. But if you look at the real allocation, equipment is just a fraction of your startup funds. The actual build-out, the real estate deposits, and those structural renovations we just talked about, they eat up the vast majority of your initial pie. Now, when you do finally get to the equipment, your cardio machines, strength racks, free weights, owners face a really critical operational crossroads. Do you buy new or do you buy used? Listen, new equipment comes with a significantly higher upfront cost, for sure, but it gives you a much longer lifespan and solid warranties. Used equipment has a much lower barrier to entry, but it demands a much higher maintenance budget and a really fast replacement cycle. Make the wrong choice here, and your treadmills will be slapped with out-of-order signs faster than you can say cardio day. Then there's your location strategy. Are you going to lease the building or try to buy it outright? Buying obviously gives you a tangible asset, but it requires staggering upfront capital. Leasing is way more common, but then, well, you're entirely at the mercy of landlords. Regardless of which path you take, the physical space has some completely non-negotiable necessities. You absolutely need adequate square footage, high daily foot traffic, and, this is huge, plenty of parking. If your members can't park, I guarantee you they won't work out. All right, Section 2, the monthly burn rate. Because once those doors open, the one-time costs stop, but the ongoing financial bleeding begins. So when a member pays their monthly fee, they probably think it's pure profit for the owner, right? In reality, it's going straight to keeping the lights on. We're talking massive utility bills, comprehensive liability insurance, ongoing equipment maintenance, your gym management software, and an absolute mountain of cleaning supplies. Gyms have to be completely spotless, and cleanliness is definitely not cheap. And obviously, we can't forget payroll, which is one of the biggest leaks in the bucket. Gyms have to manage this payroll bleed very strategically. They typically mix fixed-wage, full-time employees, like your front desk staff and the overnight cleaning crews, with variable, commission-based contractors. Think personal trainers and group class instructors. This kind of structure protects the gym's baseline expenses during slower months, while still incentivizing the trainers to hustle and bring in their own clients. Which brings us to Section 3, building the revenue engine. Because to offset all of those massive, relentless expenses, owners have to build a highly efficient revenue engine. Here's the truth. A gym simply cannot survive on a flat $20 a month membership alone. It's just not possible. Successful gyms layer their pricing. You have your basic tiers just to get people in the door, but then you layer on high-margin upsells, things like premium class packages, VIP locker room access, and personal training. It's these premium services that actually build the true profit margins. So the crucial point is this ultimate battle taking place constantly behind the scenes. Average member lifetime value going head-to-head with the gym industry churn rate. Now, churn is just the percentage of members who cancel their memberships every month, and the fitness industry is notoriously famous for incredibly high churn. People lose motivation, they move away, or they just switch to the newest trendy workout spot down the street. Gym owners basically live in constant tension, fighting to keep members engaged long enough to increase their lifetime value before they inevitably drop off. Because of that sky-high churn, a gym's marketing engine can literally never, ever turn off. You're essentially trying to fill a leaky bucket. You have to constantly funnel new members in just to replace the ones who are leaving. That means relentless local marketing, aggressive referral programs, and nonstop social media and influencer campaigns. If your acquisition slows down even a little bit, your total member count starts shrinking immediately.
Okay, let's move to Section 4, the path to profitability. This is the ultimate math test, where we finally see if the money coming in can overtake the money going out.
The break-even analysis gives us a very specific, almost magic number. By mapping out a facility's staggering fixed costs against the revenue per member, you find the exact number of active, paying members a gym needs on its roster just to hit zero every single month. Until a gym crosses that threshold, the owner is literally losing money every single day they open the doors. Getting to that magic number certainly doesn't happen overnight. Aspiring entrepreneurs need a very realistic visual finish line. Typically, months 1 through 6 are spent operating at a significant loss, as the member base slowly grows. If absolutely everything goes perfectly, month 12 might be when the gym finally breaks even. Actually, scratch that. It isn't usually until month 18 or beyond that a well-run gym starts seeing true, sustainable profit margins. You just have to have the capital to survive those first 18 months.
Now, the speed of that timeline often depends heavily on your operating model. If you open an independent gym, you have total creative and financial control, but your risk is incredibly high because you are figuring it out as you go. On the flip side, if you buy into a franchise model, you get a proven playbook, brand recognition, and marketing support that might get you to profitability a lot faster. But the catch? In exchange, you'll be handing over a percentage of your revenue and franchise fees forever.
Which brings us to our final section, Section 5, Risks and Final ROI. After exploring the staggering startup costs and the grueling timeline, we have to objectively ask, is the squeeze actually worth the juice? The grim reality is that a lot of gyms just don't make it to that 18-month finish line. The most common reasons for failure are a lethal combination of high churn and low retention. Throw in fierce local competition that splits your demographic, and it's tough. But the real silent killers of new gyms, seasonal attendance fluctuations, like those massive member drop-offs in the summer, and undercapitalization. That basically means the owner simply ran out of cash before the gym could break even. So it all comes down to a really stark contrast. On one hand, you have a massive, sometimes multi-million-dollar initial investment, paired with some seriously grueling operating hours. On the other hand, a mature, truly successful gym can generate incredible cash flow and build tremendous long-term wealth. But getting there, it requires absolute operational perfection. So I'll leave you with this thought. Does the eventual long-term ROI truly justify that massive initial investment, the razor-thin margins, and the never-ending battle against churn? It requires a rare blend of passion and